Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. Markets surge to new highs, but a shadow crisis looms. The rally is dangerously narrow, propped up by just a few tech titans. Is this the final party before the fall? Second, crisis looms. US government orders crypto for mortgages, triggering a firestorm and echoing the 2008 meltdown. This high-stakes gamble with the housing market is now official. Are we injecting catastrophic risk into the system, setting the stage for a repeat of history? Finally, the king stumbles. A startup's 1000x memory breakthrough rocks the AI industry, threatening Nvidia's dominance. Founded by laid-off big tech execs, their radical design could trigger a deflationary crisis for the entire chip market. Is this a genuine power play, or will the giant wake up in time? Here's your chance. The Senate's breakthrough on the government shutdown has sent shockwaves through Wall Street, creating a surge in tech stocks that you can't afford to ignore. The S&P 500 climbed 1.71%, closing at 6,844.16 points, primarily driven by a massive rally in semiconductor and AI stocks. Meanwhile, the Nasdaq soared nearly 2% to hit 23,461.90, outperforming the Dow, which lagged behind with a mere 0.81% gain. I'm telling you, this is a critical moment act now, or you'll miss the boat. Let's dive deeper into why this matters. The Senate's vote to advance a continuing resolution to reopen the government has shifted market sentiment from doom and gloom to optimism, but don't be fooled, this rally is built on a narrow foundation. Beneath the surface, market breadth is deteriorating, with a heavy concentration in mega-cap tech stocks driving the gains. This is a classic relief rally, and if you're holding tech-heavy portfolios, it's time to rebalance. The shutdown resolution is priced in, meaning savvy investors should focus on upcoming catalysts like the December Fed, rate cut probability, delayed economic data releases, and Nvidia's earnings on November 19th. Each of these carries significant implications for your positioning. Why should you care? Because the Fed's next move could make or break your portfolio. Fed Governor Stephen Moran's dovish comments have pushed the probability of a December rate cut to nearly 67%. But here's the catch. Inflation data due next week could derail this expectation. A surprise in the CPI or PPI numbers could collapse rate cut odds, triggering a sharp market correction. The bond market is already reacting with the 10-year Treasury yield at 4.10%. If it spikes above 4.3%, expect a rush out of growth stocks into safer assets like financials and utilities. Money is moving fast. Institutions are reallocating into semiconductors and AI infrastructure, signaling a risk-on shift back to growth. But beware, only 30% of S&P 500 stocks are beating the index, highlighting the fragility of this rally. Nvidia, Palantir, and Broadcom have seen significant gains, but these high flyers are ripe for profit taking. Rebalance into under-owned value and dividend-paying sectors like financials and consumer staples to mitigate risk. Now, let's talk sectors. Semiconductors and AI infrastructure are the clear winners, with the Philadelphia Semiconductor Index soaring. Stocks like Palantir Technologies jumped 8.8%. Micron Technology hit a 52-week high with a 6.5% gain, and Nvidia rose 5.8%. This surge was fueled by China's relaxation of export controls on critical minerals, easing supply chain fears. But don't get too comfortable, these valuations are getting stretched. Consider trimming positions in mega-cap tech and reallocating into diversified ETFs like SOXX for broader exposure. On the flip side, health insurers took a beating, with Centene Corporation dropping 8.8% amid political uncertainty over AC, tax credits. The financial sector, while not leading today, is positioned to benefit if rate cut hopes diminish. Keep an eye on ETFs like XLF, which could see inflows as investors rotate into value. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. It's time to act decisively. Short term, reduce your mega cap tech exposure by 15 to 25%, cut Nvidia, Meta, and Microsoft and reallocate into financials and dividend stocks. Target XLF, XLV, and XLP for a balanced approach. Medium term, prepare for a potential rate cut disappointment. Increase your bond duration with ETFs like TLT to hedge against rising yields. If the 10-year yield breaches 4.3%, shift more into bonds. For defensive plays, hedge your NASDAQ exposure with inverse ETFs like SQQQ, or increase cash reserves to 10 to 12% ahead of next week's CPI release. Finally, establish a contingency plan for Nvidia's earnings on November 19th. Trim your position by 30 to 40% before the announcement to lock in gains and re-enter if the stock dips post-earnings. Use call options to leverage any pullback and maintain a diversified semiconductor position through SOXX. Time's ticking. This is your last chance to reposition before the market shakes out the weak hands. Let's dive deep into today's critical market dynamics. Speaking of government actions shaking up the financial world, the US government has just ordered mortgage giants Fannie Mae and Freddie Mac to do something they've never done before: count cryptocurrency when you apply for a home loan. So the thing is, Fannie Mae and Freddie Mac aren't just any banks. They are government-sponsored enterprises that guarantee or own a massive portion of all home loans in the United States. So when they change their rules, it impacts the entire housing market. This isn't a small-scale experiment. The directive comes directly from the Federal Housing Finance Agency, whose director, Bill Pulte, announced the order was in keeping with President Trump's vision to make the United States the crypto capital of the world. Now, when we place this US directive alongside global crypto policies, the strategic divergence becomes clear. The European Union, for example, has implemented a comprehensive and strict regulatory framework called MiCA. Meanwhile, China has maintained a clear ban on cryptocurrency transactions. The US, by taking this step, is trying to position itself as the most attractive destination for digital asset innovation and capital, signaling a potential divergence in global financial rules. For the roughly 15% of Americans who invest in digital assets, this could rewrite the rules of home buying, potentially unlocking access to mortgages on homes averaging around $400,000. And believe it or not, this is tapping into a very real existing trend. A National Association of Realtors report showed the percentage of first-time home buyers using financial assets like crypto for their down payments more than doubled recently, jumping from 12% to 26%. So there is a clear and growing demand. An economist at Redfin noted that while lenders are used to assessing risky stocks, this is new territory. But the risk profile is what's really different here. Stocks have fundamentals like company earnings and P divided by E ratios. The value of most cryptocurrencies, however, is driven almost entirely by market sentiment, making their volatility far less predictable. And if you think this shift is going smoothly, you'd be mistaken. The move has triggered a firestorm on Capitol Hill. While supporters like Senator Cynthia Lummis are pushing a new bill to make the directive permanent, a group of Democratic senators are sounding the alarm. In a formal letter, they blasted the directive, labeling it a risky proposal to allow unconverted crypto assets in mortgage underwriting. Their core concern is that the notorious volatility of crypto could be injected directly into the US housing market, adding new and unpredictable stress to the system. What really brought this to a head was the immediate backlash, with some experts seeing a direct echo of the lead up to the 2008 financial crisis. After all, integrating novel, poorly understood, and volatile financial products into the mortgage system is precisely what created systemic risk back then. Critics argue this new policy introduces a similar vector for risk. If a major crypto crash happens, it could trigger a wave of mortgage defaults, threatening the stability of Fannie Mae and Freddie Mac themselves. The battle lines are now drawn between a political push for crypto innovation and stark warnings about financial stability. So, what should we watch for next? The real wild card is political uncertainty. The Federal Housing Finance Agency, or FHFA, is an independent agency, but a 2021 Supreme Court decision affirmed that the president can remove its director at will. This means the entire policy could be abruptly reversed after a future election, creating significant instability for the housing and finance industries. Therefore, the ongoing focal point will be not only the detailed implementation plans from Fannie and Freddie, but also the political climate in Washington. This is no longer just about the value of a digital coin. It's a high-stakes gamble with the American housing market at the center of the table. From a high-stakes gamble with the American housing market, we now turn to another one, shaking up the world of AI. The most unexpected news in the tech world today has to be this. A startup just emerged from stealth mode, claiming its new server technology has 1,000 times the memory of a typical enterprise server. The company is Majestic Labs, and it was founded by 3 former top silicon executives from Meta and Google. They've just announced a $100 million funding round to take on one of the biggest problems in artificial intelligence. While the world is focused on processing power, Majestic is targeting the memory bottleneck. This is where the situation takes a more complex turn, because you see the AI hardware world is actually starting to fracture. For years, the story was all about GPS, a one-size-fits-all solution. But now, with more complex AI models, the game is changing. It turns out different AI tasks have different needs. Some need raw processing speed, but others, especially for huge models, are limited by how fast they can access data from memory. This is the bottleneck Majestic is attacking. This trend suggests a splintering of the AI hardware market into specialized tools for specialized jobs, which could erode the dominance and pricing power of today's GPU giants. Their patent-pending architecture is so dense, they claim a single one of their servers could replace up to 10 of today's leading server racks. The goal is a direct challenge to the status quo, aiming to slash the massive data center costs for hyperscalers and large corporations. And a quick connection to something we flagged a while back, the industry's crunch around power, land, and interconnection queues. If fewer boxes can do the same work, it could compress footprint and rack count, potentially easing part of that pressure though. As always, the real test is where the power and cooling requirements actually net out in practice. And the stakes could not be higher. Tech giants like Alphabet, Meta, Microsoft, and Amazon are on track to spend a staggering $380 billion this year, primarily on the exact data center infrastructure. Majestic wants to disrupt. A while back, we walked through how Amazon raised its 2025 capital spending forecast to roughly $125 billion, and how Microsoft and Alphabet have been revising their budgets higher in what we called the AI capital expenditure arms race. Today's number slots right into that bigger pattern of ever-rising infrastructure commitments. But that's not the whole picture. The real turning point for the entire industry is this. If a company like Majestic succeeds, it could trigger what some analysts are calling an AI capital expenditure deflation risk. Let's break that down. Capital expenditure is just short for capital expenditures, the huge sums of money these giants spend on physical assets like servers. For context, Meta recently raised its 2025 capital expenditure forecast to over $70 billion, with Alphabet raising theirs to over $90 billion, all driven by AI. We previously analysed how cloud profits think AWS's outsized operating income are a major engine funding these bets, and how budgets have been getting revised up in waves. Simply put, if new technology allows one server to do the work of 10, these hyperscalers might not need to buy as much hardware in the future. This could deflate the massive valuations across the entire semiconductor supply chain, putting pressure on market leaders like Nvidia, and it would be a notable counterweight to the upward revision cycle we've been tracking. But the rabbit hole goes deeper. The story behind the company's founding is a dramatic plot twist. Majestic's CEO, Ofer Shacham, was previously a vice president at Meta, where he led the company's custom silicon team. During the 2023 layoffs, he was the one who had to let his own team members go, calling it not a good place to be. As we discussed a while back, big tech has been shedding headcount even amid record performance, shed the old to fund an all-in bet on AI, and this is exactly the kind of second-order effect you get. Talent spinning out to build what incumbents couldn't ship internally. The situation presents a fascinating duality for the incumbents. On one side, a brain drain of senior, experienced talent, while on the other, it seeds a new ecosystem of smaller, more agile competitors who could potentially out-innovate them without the corporate bureaucracy. This is a perfect example of a bigger trend. The great unbundling of big tech talent, the very team that was dismantled at Meta, a unit that struggled to produce competitive chips internally, is now regrouping outside the corporate walls. Now, he and his co-founders are building a new team, tapping into their network of over 1,500 former colleagues from Google and Meta, with prototypes planned for 2027, a small team of fewer than 50 employees, born from the restructuring of big tech, is now armed with a radical design to challenge the entire architecture of the AI gold rush. However, let's add a dose of reality. That 2027 prototype target is a crucial detail, because disrupting the semiconductor market is a slow, incredibly capital-intensive process. A multi-year timeline is a lagging indicator of how long innovation takes in this field. This gives incumbents a massive window to react. For example, Nvidia's own public roadmap shows its next generation Rubin Ultra architecture is also slated for 2027 and is expected to feature a huge leap in on-chip memory. This sets up a race against time. And remember, we've noted how capital expenditure cycles tend to get revised upward as needs outstrip initial plans, all while energy and interconnection constraints remain a wild card. Some say demand is overstated. Others see a looming power shortfall. So the billion-dollar question to watch is whether Majestic can bring its unique product to market before giants like Nvidia co-opt their innovation, potentially neutralizing their advantage before they even ship a single server.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.